This week, global markets were hit by a shock few investors saw coming. Oil surged from $67 to $91 in just days, the largest weekly jump since 2022. Volatility exploded, bond yields spiked, and suddenly the assumptions investors had relied on for months began to unravel. A geopolitical escalation in the Middle East has triggered a chain reaction across energy markets, currencies, equities, and central bank policy, and the consequences may only be beginning. Welcome to the Weekly Market Podcast, where advanced AI delivers deep, institutional-grade analysis of global markets, economics, and geopolitics. Every week, we cut through the noise to explain what is actually moving global capital. In today's episode, we break down the global market shock triggered by the recent geopolitical escalation, why the surge in oil could reignite inflation worldwide, and the 5 critical risks investors must monitor next week. Stay with us until the end, because the final question may challenge one of the most fundamental assumptions in modern investing, whether the traditional 60-40 portfolio still works in today's world.
It's Saturday, March 7th, 2026. And if you're looking to understand exactly what is moving global capital right now, well, you have definitely found your home.
We are the #1 market show on YouTube for a reason. We cut through the noise, drop the impenetrable Wall Street jargon, and just look strictly at the signals.
Right, the signals dictating where markets are heading next. And this week, the foundation of the global economy experienced just a massive seismic shift.
It really did. We watched geopolitics violently collide with a very fragile global economic momentum.
Yeah.
And the assumptions that traders are relying on just a few days ago, they've been completely torn apart.
Totally torn apart. But before we tear into the numbers, a critical note for you listening. Our research today focuses heavily on the market fallout from the recent U.S. and Israeli strikes on Iran.
And we're looking at this strictly through a financial and analytical lens.
Exactly. We are absolutely not taking any political sides here, nor are we endorsing any specific geopolitical viewpoints. Our mission is to impartially report on the data and the facts as they stand, just helping you understand the real-world impact on global markets. We follow the numbers, period.
Because the data tells a very specific story, and, well, our job is to translate the mechanics of that story for you.
And it is a massive story. So to help break down a truly historic week, I've got our resident top-tier global bank strategist here to help you separate the signal from the noise, protect your portfolio, and maybe spot a few hidden opportunities.
Always glad to be here.
So here is your roadmap for today's deep dive. We are going rapid fire through a region-by-region breakdown. We've got the U.S., Europe, the UK, Japan, and China.
Then we're previewing an absolute monster of a data calendar for next week.
Right. And finally, we are counting down the definitive top 5 risks you absolutely must monitor right now. So let's get straight into the global shockwave. I want to start with the ultimate fear gauge, the VIX.
Yeah, the VIX had a wild week.
It surged nearly 50% this week to hit 29.5. Now, for anyone who doesn't stare at Bloomberg terminals all day, break down the VIX for us. Why does hitting 29.5 actually matter?
So the VIX measures the implied volatility of S&P 500 index options. Think of it as the price of portfolio insurance. When markets are calm, insurance is cheap, and the VIX sits down in the low teens.
Makes sense.
But when the VIX spikes to nearly 30, a level we haven't seen since the tariff panics of last year, it means institutional money managers are panic buying protection.
Right, they're terrified.
Exactly. They are willing to pay massive premiums because they believe violent price swings are imminent.
But the real catalyst here isn't just a generalized sense of fear, it's energy. Specifically, the massive jump in oil from roughly $67 to $91 per barrel.
That is the largest single weekly surge since 2022.
A $24 jump in a matter of days is just staggering.
It fundamentally changes the map for every major economy. The central issue here is the geography of the conflict. The market is pricing in the fear of supply disruptions in the Strait of Hormuz.
Which is incredibly vulnerable.
It is. A massive percentage of the world's daily oil consumption passes through that specific naval choke point. When military conflict threatens that supply line, commodity traders, they do not wait to see if a tanker actually gets delayed.
They act first.
Right. They price in the worst-case scenario immediately.
And why this matters to you, the investor listening to this, is that $91 oil instantly reignites global inflation fears. For months, markets have been aggressively betting on a smooth disinflation narrative.
That comforting idea that central banks had finally won the war on prices.
Yeah, exactly. But a $24 spike in crude threatens to completely dismantle that narrative.
Which brings us to the collateral damage in the bond market. Because inflation erodes the value of fixed returns, bond investors immediately demanded higher yields to compensate for that newly perceived risk.
And we saw the 10-year Treasury yield gap up from 3.96% to 4.15%.
A massive, massive move.
And that move in yields perfectly explains the carnage we saw in the United States regional breakdown. Let's look at the U.S. equity scorecard. Stocks fell for the second straight week, but the internal damage, it's fascinating.
The divergence is what you really need to look at.
Right. The tech-heavy Nasdaq held up relatively well, down just 1.2%. The S&P 500 dropped 2.0%, and the Dow fell 2.9%. But small and mid-caps were absolutely crushed. The Russell 2000 plummeted 4.0%. Why did the smaller companies take double the damage of the broader market?
It comes back to that spike in the 10-year yield. The Russell 2000 is full of smaller domestic companies that are highly reliant on floating rate bank loans and constant debt refinancing.
So they need cheap money to survive.
Exactly. Tech giants in the Nasdaq are sitting on mountains of cash, right? They don't care if borrowing costs tick up. But a regional manufacturing firm in the Russell 2000, when the cost of capital suddenly jumps, their profit margins get instantly squeezed.
Investors know this, so they dumped small caps and fled to defensive positioning.
That's exactly the play.
Now, let's dig into the domestic U.S. data from this week because, frankly, it looks like a typo. We have a massive contradiction.
The labor versus business data.
Yes. First, the bad news. February payrolls shockingly dropped by 92,000 jobs. That missed every single Wall Street expectation, and the unemployment rate actually ticked up to 4.4%.
But then we get the ISM surveys.
Right. And for those unfamiliar, the ISM issues Purchasing Managers Indexes, or PMIs, which track actual business activity. Anything above 50 means the economy is expanding. The services PMI jumped to 56.1, and manufacturing expanded to 52.4.
Solid expansion territory.
So help me understand this. How can businesses be booming and expanding output while simultaneously shedding nearly 100,000 jobs?
It looks completely contradictory until you realize we are seeing the results of corporate efficiency measures catching up with forward-looking panic.
Doing more with less.
Precisely. Businesses are maintaining output and profitability by leaning on previous investments in technology and automation. However, because of the geopolitical uncertainty we just discussed, CEOs are freezing new hires or aggressively cutting headcount.
So they are expanding today's output while preparing for tomorrow's potential crisis.
Exactly. And that creates an absolute nightmare scenario for the Federal Reserve.
It leaves them trapped in a room with the walls closing in.
Completely boxed in. On one side, you have rising energy prices threatening to push inflation back up, which traditionally demands higher interest rates to cool the economy.
Right.
But on the other side, you have a suddenly contracting labor market with negative job growth, which historically begs for interest rate cuts to stimulate hiring.
They are paralyzed. If the Fed cuts rates to save jobs, they risk letting oil-driven inflation run hot. But if they hike rates to fight the oil shock, they might trigger a massive recession and send that 4.4% unemployment rate soaring.
Their next policy move is shrouded in total uncertainty right now.
But as tough as the U.S. puzzle is, Europe is staring down an absolute disaster. Let's pivot our deep dive to the Eurozone and the UK.
It was a bloodbath in Europe.
Europe just suffered one of its most brutal weeks in months. Germany's DAX crashed 6.70%. The French CAC 40 fell 6.84%. The FTSE MIB in Italy dropped 6.48%, and the broader StoXX Europe 600 was down 5.55%. The U.S. market took a hit, but Europe got decimated. Why the massive divergence?
Structural vulnerability. Europe has an intense reliance on imported energy. They do not have the massive domestic oil and gas production buffers that the United States has built up over the last decade.
So they take the hit immediately.
Instantly and acutely. When global energy prices spike $24 in a week, the European industrial base feels the pain directly in their operating costs.
I've heard analysts throwing around the ugliest word in economics this week regarding Europe stagflation.
It is the economic equivalent of being stuck in quicksand. Stagflation is the toxic combination of stagnant economic growth and rising inflation.
And the data this week paints that exact picture. Eurozone CPI, their main inflation gauge, surprised to the upside, hitting 1.9%. But paradoxically, their unemployment hit a record low of 6.1%.
Right, and that low unemployment is the trap.
Wait, a record low unemployment rate sounds like a good thing. Why is that feeding into the stagflation quicksand?
Because a tight labor market means workers have leverage to demand higher wages. So you have wage inflation driven by low unemployment, compounding with imported price inflation driven by energy costs, all while broad economic growth is flatlining.
Wow. The market is looking at this toxic mix, and the odds for an unexpected European central bank rate hike have now crossed the 50% threshold.
They might have no choice but to hike into a stagnating economy.
And the pain wasn't isolated to the continent either. The UK took a massive hit. The FTSE 100 dropped 5.74%, and the British pound sank to its lowest level since December.
And the data out of London was a really mixed bag.
Yeah, the UK construction PMI slowed down significantly, showing that high borrowing rates are really biting into development. But then Halifax house prices unexpectedly rose 1.3% year over year.
Real estate often lags behind broader market panics, or it just reflects a localized lack of housing supply rather than true economic health. But the most alarming takeaway from the UK this week wasn't the housing data.
It was the stark warning from their Office for Budget Responsibility.
Exactly. The OBR explicitly stated that the Middle East conflict threatens very significant impacts on their fragile economy.
Government bodies usually speak in heavily sanitized diplomatic terms. When an internal watchdog uses language like very significant impacts, it means their risk models are flashing bright red.
They are terrified of an energy-induced recession.
Let's move our focus over to Asia and look at Japan and China, because the dynamics there are incredibly complex. Starting with Japan, their markets showed massive vulnerability. The Nikkei dropped 5.49% and the T2PX fell 5.63%.
Japan is caught in a vicious cycle right now. Much like Europe, they rely heavily on oil from the Gulf. But their specific trap is tied to their currency.
The yen.
Yes. The Japanese yen weakened significantly this week, hitting 157.6 per US dollar.
I'm looking at that yen weakness, and at the exact same time, oil is spiking. How do those two things interact to create a crisis for an industrial manufacturer in Tokyo?
It acts as a brutal multiplier effect. Global oil is priced in US dollars. If you're a Japanese factory owner, you have to convert your yen into dollars to buy that energy.
Okay.
If the baseline price of oil jumps $24, that hurts. But if your home currency is simultaneously losing value against the dollar, you are getting squeezed twice. It is like paying a cover charge to enter a restaurant where the menu price is just doubled.
That is a brilliant way to put it, and this dynamic creates a massive threat of imported inflation for Japan.
It has gotten so bad, the Japanese officials are actively warning of foreign exchange intervention to prop up the yen.
But domestic pressures are mounting too. Japanese labor unions are currently demanding 6% wage hikes, which is virtually unheard of in their recent history of deflation.
Right, so you have imported inflation from energy, domestic inflation from aggressive wage hikes, and a collapsing currency. This forces Bank of Japan Governor Kazuo Ueda to signal continued rate hikes.
But trying to hike interest rates while the global economy shudders from a geopolitical shock is an incredibly delicate and dangerous operation.
One wrong move, and they crash their own debt markets.
Now, here is where the data gets genuinely surprising. In a week characterized by a global sea of red, Chinese equities saw the smallest declines by far.
They barely flinched relative to the rest of the world.
The CSI 300 was only down 1.07%, the Shanghai Composite fell just 0.93%, and the Hang Seng dropped 3.28%. Considering China's reliance on global trade, why did they show such relative resilience?
We are witnessing a major strategic policy pivot from Beijing. China is actively trying to insulate itself from the global chaos. They set the tone for this earlier in the week with their new 2026 GDP target.
Setting it at 4.5 to 5%.
Right.
For context, that is their lowest growth target in decades. The era of double-digit Chinese expansion is officially dead. But setting a lower target doesn't explain market resilience. What is the hidden layer here?
Beijing is no longer trying to juice headline GDP numbers by aggressively building empty apartment complexes or unnecessary provincial infrastructure. They are choosing strategic, targeted growth.
They announced 800 billion Chinese yuan in new investment financing.
And they are allowing local governments to issue 4.4 trillion yuan in special bonds.
Mm-hmm.
The resilience comes from where that capital is being deployed. Tech self-sufficiency and advanced manufacturing, they are attempting to build a fortress economy.
You can actually see this pivot happening in real time if you look at the split in their purchasing managers indexes.
The PMI data there is fascinating right now.
The official PMI, which heavily tracks massive state-owned enterprises, showed a contraction at 49.0. But the private kicks in PMI, which tracks smaller, agile, export-oriented private firms, jumped to 52.1, solidly into expansion territory.
That split is the key to understanding modern China. The old state-owned heavy industry is struggling, but private advanced manufacturing is booming.
It completely changes how global investors have to think about allocating capital in emerging markets. You cannot just buy a broad China index anymore. You have to target the specific sectors Beijing is fortifying.
Exactly. The old playbook is dead.
Okay, we've covered the damage, the contradictions, and the pivots from a truly historic week. Let's look forward. It is time for the calendar preview for the week of March 9th through March 13th.
The stakes could not be higher.
They really couldn't. Next week's data drop will single-handedly dictate whether markets stay panicked over geopolitics or if they pivot back to obsessing over monetary policy. Let's run through the U.S. data avalanche.
It really is an avalanche, and the market will be hypersensitive to every single print.
On Tuesday, we get existing home sales and the NFIB Small Business Optimism Index. Wednesday's massive, the critical CPI inflation reading, along with the Fed budget statement.
Wednesday is going to be incredibly volatile.
Then Thursday, we see the trade balance, housing starts, and weekly jobless claims. And then Friday is the monster. We get the PCE price index, the second estimate for Q4 GDP, JOLTS job openings, durable goods, and the University of Michigan consumer sentiment.
So much data packed into 48 hours.
We've got CPI on Wednesday and PCE on Friday. Why does the market care about both? And why is Friday's PCE considered the Fed's preferred gauge?
CPI, or the Consumer Price Index, measures the changing out-of-pocket costs for a fixed basket of goods. It is a great quick-hit snapshot. But PCE, the Personal Consumption Expenditures Index, accounts for substitution.
Substitution?
Yeah. If the price of beef skyrockets and consumers start buying chicken instead, PCE adjusts for that change in consumer behavior. It provides a more comprehensive look at true inflation.
Got it.
If Wednesday's CPI and Friday's PCE both show that inflation is accelerating due to energy costs, the market will aggressively price out any remaining hopes for a Fed rate cut this year.
And globally, we aren't getting much of a break either. On Monday, China releases its inflation rate, followed by its trade balance on Tuesday.
That trade data is crucial because it acts as a real-time thermometer for global export demand.
Then on Friday, the UK releases its January GDP estimate. The market will be watching to see if they are officially slipping into that stagnation we discussed earlier.
As for Europe and Japan, the calendar is less about scheduled data releases and more about headline risk.
Markets will be watching the geopolitical wire and energy prices tick by tick while listening very closely for any sudden Bank of Japan commentary regarding currency intervention.
It is going to be an intense 5 days.
To ensure you are fully prepped, we are finishing today's deep dive with the definitive top 5 risks you must watch to protect your portfolio. We are going to count these down and debate the severity. I'll kick us off with number 5.
Let's do it.
Number 5, a China growth slowdown. We just talked about their new strategic pivot and lower GDP target. The risk here is purely execution. If China's targeted stimulus measures disappoint and they fail to hit even that lowered 4.5% target, emerging markets and global commodities will face immense downward pressure.
Number 4, currency volatility in Japan. The yen is hovering at dangerously weak levels. The underlying risk here is contagion. Sudden foreign exchange interventions by the Bank of Japan to prop up the yen could create massive, unpredictable turbulence across all global currency markets.
Contagion is always the terrifying word.
It could force massive macro hedge funds to rapidly liquidate positions in completely unrelated assets just to cover their currency losses.
Number 3, labor market weakening in the U.S. We saw February payrolls drop by 92,000. You need to watch Thursday's jobless claims and Friday's JOLTS data like a hawk. The risk is narrative momentum. We need to know if that negative 92K print was just a weird statistical blip or the dark beginning of a true recession.
Number 2, a U.S. inflation surprise. Wednesday's CPI and Friday's PCE are the linchpins for the entire year. If those reports show that inflation has become sticky and resistant to current interest rates, rate cuts get delayed indefinitely.
And bond yields will spike even further.
Exactly, putting immense downward pressure on equity valuations across the board.
And finally, number 1, an oil supply shock escalation. This overrides everything else. The primary risk is a physical disruption in the Strait of Hormuz pushing oil past $100 a barrel.
If that happens, it triggers a much deeper systemic equity sell-off globally.
It renders every piece of domestic economic data we just talked about practically irrelevant.
When you synthesize all of this, the overriding theme is that global markets are currently operating without a safety net. The traditional buffers are gone.
It's all exposed.
Geopolitical tensions, imported inflation risks, and paralyzed central bank policies are now dangerously intertwined. A localized shock instantly transmits through the entire global system.
It is a completely interconnected matrix, and the speed at which the market prices in disaster is faster than ever. Which brings me to a final thought for you to mull over this weekend. We've seen how a geopolitical event thousands of miles away can instantly reprice global energy, tank the Japanese yen, and completely paralyze the U.S. Federal Reserve, all in a matter of days.
It happens in the blink of an eye.
So the question you need to ask yourself is this. If we are entering a new paradigm where sudden geopolitical shocks are the norm rather than the exception, does the traditional 60-40 investment portfolio, 60% stocks, 40% bonds, actually offer any real protection anymore?
That is the defining question for the rest of the decade.
Or is it time to fundamentally rethink how we hedge our wealth against a hyper-connected, incredibly fragile world? Think about it. Thank you so much for joining us for this deep dive. Stay informed, stay vigilant, and stay ahead of the markets.
We will see you next time.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.